This week on Generating Alpha, I sat down with Pete Muller, founder and CEO of PDT Partners, one of the most successful quantitative hedge funds in history. Pete grew up in Wayne, New Jersey as the son of immigrant parents. After graduating from Princeton with honors in mathematics, he moved to California to play music for rhythmic gymnasts. He eventually found his way to BARRA, doing quantitative work, and then in 1992 convinced Morgan Stanley to let him start a proprietary trading desk called process-driven trading. For nearly 2 decades, PDT averaged 20% annual returns and was Morgan Stanley's most profitable group. After spinning out in 2012, the firm has continued that track record. The flagship fund has never had a down year since 1993. But in 1999, despite extraordinary success, Pete was miserable. His mind was so overloaded with formulas he couldn't play music anymore. You took a 7-year sabbatical, trekking in Bhutan and busking in New York City subways. And today, he spends 2/3 of his time in Santa Barbara, has released 7 studio albums, creates crossword puzzles for the New York Times, and has made the final table at the World Series of Poker. His firm charges 3 and 50 and has a 3.5% turnover rate. In our conversation, we talked about learning quant finance in the 1980s, the audacious pitch that created PDT, the 2007 quant crisis and institutional constraints, burnout and rebirth, how music and mathematics feed each other, building for quality over scale, and designing a life that doesn't require choosing between the things that matter most. If you enjoy this episode, please follow the podcast and rate it 5 stars on Spotify, subscribe on YouTube, and share it to anyone who you think might find it valuable. This is an incredible episode, and I really enjoyed recording with Pete, and I hope you guys enjoy listening. Thank you. Thanks for joining me, Pete. I really appreciate it.
Amir, thanks for having me.
Well, I want to start where I always do, the beginning. You grew up in Wayne, New Jersey, immigrant parents. If I'm correct, you had an Austrian father who was an engineer, Brazilian mother who was a psychiatrist. Tell me about your environment growing up and in what ways do you think that shaped you?
Sure. Although I would say I haven't grown up yet. I was raised in New Jersey. My mom was a small town doctor in Brazil. She was the only town doctor before coming to the States and switching to psychiatry. I was in my head a lot as a kid. I was drawn to both math and puzzles and games and music. I was outdoors a lot, but definitely in my head a lot. Um, yeah, had no interest in finance or markets.
And you eventually go on to Princeton, studying math, but if I'm correct, also playing in a jazz band. Uh, and
Yeah.
after graduating, you moved to California, and play music for rhythmic gymnasts instead of taking a corporate job. I'm not even sure what rhythmic gymnasts mean. Tell me about why you made that decision, your time in
Yeah,
college, kind of, yeah.
sure. I'm at Princeton. I'm in an eating club, and I have a friend who is trying out for the Olympics team, the Olympics. And back then, so rhythmic gymnastics, the hoop, ball, ribbons. It's a branch of gymnastics, but they have Olympic medals. And there were two women that made the U.S. team. And she asked me to compose a piece for her. She ended up loving it. She wanted me to accompany her for Olympic tryouts, and I went and did that in Atlanta, played at the Olympic Sports Festival. She came fourth. If she had come first, which was a long shot, I would have been the Olympic pianist. But I met a coach in California that said, if you're ever in California, come play music for my team. And I had a job lined up at a German computer firm in New York City. I had worked for them for a couple summers, and I just didn't want to go do a 9 to 5 job. Just go to an office. And I thought, let's go to California and see how this plays out. And I went there, and I realized that it's very tough making a living as a rehearsal pianist for a rhythmic gymnastics team. As much as it was fun, and I loved California, so I went looking for a job, and that's where I found a company called BARRA, which did financial consulting, started by a Zen Buddhist guy named Bar Rosenberg, a wonderful human, and turns out finance is all math and modeling, and it just suited me. And I had a couple of really great mentors, a fellow named Richard Bernold and a guy named Arjun Devecha. Richard was a prof at Berkeley, and Arjun ended up managing tons of money at GMO, and they took a liking to me and taught me the business, and I got really interested. So I started doing talks and writing papers. So that's how I got into it.
Incredible.
accidentally.
And that
I
was
actually played piano. I played piano for that gymnastics team for at least a year while I was working at BARRA before giving it up.
it's a fun overlap. And I'm correct, you were at Barra around mid to late 80s, and that was kind of very during the very early days of quantitative finance.
85 to 92.
Yeah. So during the kind of earlier days of quantitative finance, what was it like being there kind of while the industry was evolving?
I mean, it was nascent. People didn't understand what we were doing, and there was no such thing as the technology was tough, the data was tough, um, but the modeling turned out to be very useful. I mean, a lot of what we did was really we were hired by pension funds who were allocating money to managers, and the managers were being evaluated through our models, and so the managers had to hire us for the models and realize that maybe they could help. And yeah, it was a start. Kind of looking at everything on a monthly basis. It was early days.
And after leaving Bar, if I'm correct, in 92, Morgan Stanley wanted to hire you as an analyst, as a quant analyst. You said no. And then I'm pretty sure you counteroffered and were like, let me start my own trading desk with proprietary, with Morgan Stanley's money. What gave you the conviction to even ask that of them? And why do you think they ultimately gave you that desk?
It's a very reasonable question. So I had learned how to play poker with a few friends, and we got pretty good. I kind of got a little bored at Barra. It was very comfortable, um, but I just didn't have the edge. And the three of us that played poker actually pitched to Barra that we should start doing trading with our own money. But it was a really horrible pitch. I mean, if somebody had pitched me with that, I would have never said yes. That was very naive. But I realized it's kind of what I wanted to do. And then a number of other firms talked to me about doing it, but I never found somebody that was interesting. And then Morgan actually wanted me to write papers, travel around, talk to clients, kind of be the face of quant at Morgan Stanley. But it meant, putting on a suit and tie and flying around the world and talking to people about quant as opposed to doing it. And I said, I want to try to do this. And they said, can you? Have you ever done it? And it was a very valid question. And I said, well, I got pretty good at poker. I learned how to do that. I think I can figure this out. And they said, okay, here's the deal. We'll give you a couple of years, try it. And if it doesn't work out, you'll do what we want you to do. And they thought, you know what, he's going to find it too hard, like most other people. And then we'll have the guy that we want. And I thought, I'm going to find a way to do this. And so I took a chance, and they guaranteed me enough to come to New York and give up my life in California, which was really nice. That I said, let me take a risk. And then somehow, yeah, took a while to get back to California, but I did.
And you took that risk, and PDT kind of started around 1993 and eventually spun out of Morgan Stanley in 2012 as an independent firm. I'm really interested, just like from a high level, before we get to the more kind of granular questions, the evolution of the firm over those 20 some years. What milestones do you think were like the biggest and that kind of shaped the investor that PDT is today?
There are a lot of stories in there, and one day maybe I'll write a book because the journey was fantastic. It took us a couple of years, and I was lucky enough. I grabbed a colleague of mine from college, from Princeton, who I played ultimate frisbee with, Ken Nickerson, to help build some of those models in early days. I was lucky enough to find someone who had gone to MIT gotten both an MBA but also an advanced degree in electrical engineering, who had been at Morgan Stanley for a while, and named Kim Alcessor, and a fellow named Frank Boquicchio, who helped us out with our tech. And somehow creating that team, it just worked. And after a few years, we actually really figured out how to make money, which was really great because the person that had taken the chance on me and brought me in got, had a falling out politically at Morgan. And it was just a question of, if we had not been making money by then, they would have said, well, what the heck is this? Get rid of it. But we were starting to make enough money, and they realized that we were smart. So they kept it going. And then all of a sudden, the growth was exponential until we were by far the most profitable group. 6 years later, it was fantastic. But there was a time when I didn't think I would be there, that I actually went and I haven't told many people this, but I interviewed with Long Term Capital,
Oh,
You know,
wow.
the thought was, and because they didn't know how to do equities at the time. They didn't, we were pretty good at statistically doing equities. A lot of people didn't think it was possible. Um, and, uh, and I talked to them really seriously. I had a dinner with all the partners, but for whatever reason, we didn't pull the mutual trigger and take, and airlift the group out. And I think if we had gotten a serious offer, we would have, because my position at Morgan Stanley was so unstable. But kind of dodged that bullet. The angels were looking down, and started making money. I ended up working for a fellow there named Vikram Pandit, who
Oh, yeah.
kind of understood what we did, and it was like, you know what, Pete, I get it. I trust you. I mean, initially he was like, wait a second, you guys have all these models and secrets, and we have to understand them. And I'm like, yeah, a lot of people in the group that understand them. And it worked really well. The interesting thing is it's around I guess it was 99, 2000. Kim Alcessor, who was my partner in the group, came to me and said, you know what, I'm done. I have enough money. I want to move to LA. And I all of a sudden realized I wasn't having that much fun anymore. I'd made more money than I ever dreamed of. That was never the goal. And I decided I was done too. I went through a breakup, started songwriting, and I came up with a plan to leave. And I thought I was going to basically be gone. I started another firm with a friend of mine called Chalkstream Capital that was allocating to other hedge fund managers. And I thought, um, been there, done that. Give the business to the group, let them do it. And had a deal with Morgan where I phased out for 5 years. Vikram was great. Vikram was like, you know what, Pete, do whatever you want as long as you make sure it keeps going. So the whole bonus pool got turned over to the group. I got a little deal, and I kind of was basically done. And then life circumstances changed, and it looked like they were not going to thrive past those 5 years. So kind of at that last year, I came in trying to help a little bit, and pretty soon, because that's just what I'm good at, I was running the group again.
Yeah.
Came back and made a number of decisions that I think, one of them almost blew up the firm, but I think the big one was, really important for us to actually be where we are today, which was to start hiring a lot of smart people. There was a cautiousness in the culture. My God, we figured out these secrets. This is great. Let's not tell anybody. And I realized that the only way to get really good was to keep growing and to keep learning and to keep pushing forward. And so I made sure that happened. And then after the crash of 2008 and the Volcker rule, which said banks can't own proprietary trading groups, we once I was close to passing, we had a very amicable split with Morgan, where we basically moved out of their offices but kept running their money for a couple years. Huge trust. And we raised the first fund. We found a core investor that was willing to lock money up for 7 years, and all we did was promise not to give it back for 7 years. And then that helped us raise enough money to replace Morgan Capital, since they weren't allowed to invest. And it was so amicable that all 80 people came with us from Morgan to PDT, to the new entity in 2012. We had already been outside for 2 years, so it was comfortable. And we even took the book that was at Morgan Stanley on December 31st and transferred it to the fund. We didn't even have to pay the transaction costs to get out and back in.
Oh, wow.
And we still have a great relationship with Morgan Stanley. They got a share of our profits for a while, but that has ended a long time ago. And then we've grown. So there you go.
I'm super
And I
fascinated.
found,
Yeah.
sorry, again, I
I'm
actually found when I came back that I could pursue music, which I love to do, and also run the business, and empower people to do it. And I think now I've got a crew that can do it better than I can, which is great.
Before we go back to the episode, I want to take a short break to talk about my sponsor, Row. The Generating Alpha podcast is presented by Row, the all-in-one banking platform for startups. Thousands of startups like Perplexity, Product Hunt, and more use Row. You get everything you need to manage your startup's cash. Fast banking setup, cards with up to 2% cash back, and yield that turns company cash into extra runway. All super important in the early days of launching. But the thing founders really love about Row is their team. They're obsessed with helping founders disrupt the status quo and will go to the end of the earth to help them to do so. And exclusively for Generating Alpha podcast listeners and viewers, you'll get a $1,500 statement credit plus a ton of exclusive perks when you manage your company cash with Row. Terms and conditions apply. To learn more, visit rho.co/generatingalpha. Row is a fintech, not a bank. Checking and card services provided by Webster Bank, member FDIC. See reward terms for details. Thank you, and back to the episode.
Since
Incredible.
there are a lot of things I
And
love to do. Go ahead.
I'm super interested, like zoom in on that 7 year sabbatical you have of like, tell me about the things you did during that period. And ultimately you learned about a little bit of balance so you can do music and this, but like, what did you learn over that period?
Well, it was a 5 year thing,
Okay.
maybe 4.5, and it wasn't a full sabbatical. The first year I came in, I think it was 2 to 3 days a week. The next year it was like 1 to 2. Then it was a day a week. Then it was a day a month.
Okay.
Right. So but it was spacing it out. But I really dove into music, and I thought that was going to be the thing I did. Did a couple albums, and I'd always played it, but I hadn't really written, I hadn't really sung, and I had a long way to go. So I did a lot of learning, started a songwriter circle. That was a big thing. The first sabbatical I took, I traveled for 7 months. I went to Bhutan. I went all over the U.S., kayaked the Grand Canyon. I mean, did a lot of really, really cool, fun outdoor things. But then when I came back, it was more about, kind of finding myself again and discovering the spiritual side, some of the things that led to, things not working out. And yeah, um, it was a fascinating journey. I also started Chalkstream with my friend Andrew Tsai. The thought was that was going to be my investment vehicle. I thought, I can't be that unusual. There are going to be a lot of other people that have started hedge funds that I can find, and I can figure out early days, back them. It turns out there are people, but it's really hard to do and really competitive. And, Chalkstream has done fine. It's still running. But I eventually, when I went back to PDT, Andrew came and joined us over there. Yeah. And the firm's continued, knock on wood, to thrive and evolve and, just grow with new technologies. I think the strength we have, which I think is really, really important, is that for me, our goal is to be the best place to work in quantitative finance.
Mhm.
We want our people to be having a great time. We love hiring the smartest people we can find, but they need to be collaborative and they need to be kind. So we have an amazingly warm place to work. People are really nurturing. They like to help people. I mean, that came from my values, and that collaboration and that trust is, the fundamental underpinning of our culture. And I think that's so important, and that's a real competitive advantage we have, right? Because it's based on trust. They trust that if they devote themselves really hard and work really hard, that we're going to take care of them, that they're going to share in the success. We trust them that, we can share secrets with people and they will stay there and keep them there. I mean, and that's one of the big things that you have to worry about in quant trading if people leave with your models. So that trust is great. And people are not afraid internally to share ideas with other people because they're not worried about, oh, I might not get credit, so on. So I think when it comes down to it, that culture is huge. And when we interview people, they come there and they look around and they say, oh my God, this seems amazing, but it can't be. And then when we hire them, they join and they're like, you know what? I thought it was too good to be true in my interview, but it actually really is like this. I would give my partner Tushar Shah a lot of credit. He is an amazing physicist. He could be running a research lab anywhere. And he was one of those people when I came back to the firm that I spotted that was not afraid to hire people and to grow a research group. And, he's really made a huge difference in building up our research culture. Very grateful for that. And I think without him, we wouldn't be where we are.
And how do you make sure that the culture is a culture of excellence, but not excellence in the way of like people burning out, but rather excellence in the way of like really being cordial, being nice, and then delivering great returns?
The same way you incent behavior, you reward good behavior. So we pay people for being collaborative,
Yeah.
not just for making money. And if you're a jerk, and you're really good, but you're a jerk, you're not going to last. We don't have jerks, and it's worth it. And then when you have a culture where people don't tolerate jerks, if somebody has some jerk tendencies but is basically good, that actually helps to decrease those tendencies, and the behavior becomes good, right? So you want to kind of fit into a culture and do well, right? So So part of it is, if there's anything, we want to make sure that the competitive drive and the drive for excellence is still there too. So we want people to be, ruthless, just not ruthless versus their colleagues. It's ruthless versus building the models and beating the market, figuring that out. And you reinforce that, you talk about that, and it mostly works. I think that's the main thing. You can kind of shape human culture and shape behavior. I think the most important thing is, and you can't fake this, you have to genuinely care about people. So if we have someone who's struggling, and this could be a junior person that we've hired that's just not getting it yet, or a senior person that kind of did some stuff but kind of isn't in the right role, we bend over backwards to try to help that person find a new position to make it work. A lot of people talk about, okay, a company's not a family, right? It's more like a sports team. We kind of go a little bit more family that way. That's our way of looking at it. It might be inefficient, but I will tell you that it feels a lot better. It's a lot more fun. And for us, it's worked really, really well.
And I'm super interested in kind of the aspect of size of you've said that you want to be the best quant firm on the planet, in terms of obviously the people working there and the kind of culture, but specifically not in terms of assets, but in terms of quality of products, both I'm sure in returns, but also I'm sure in people that you hire. And you guys are at around mid teens of billions of assets under management now, um, and probably could be much bigger. When does size kill returns?
Um, we spend a lot of time thinking about that. It's not just returns. It's the bigger you get, the more volatile you get. Your Sharpe ratio goes down.
Yeah.
It doesn't work as well. Um, and for the way when we started our partners fund, we told people, and we started with 1.5 billion, and we told people, eventually we are going to replace this just with our money, right? And we will kick you out. And that's why we kept the deal with our first investor that we promised we wouldn't kick out for 7 years. And we've continued to do that. So our partners fund, we've kicked everybody out of. That's all our money, and that's more than half of what we manage. And our other offerings, we will slowly do the same thing and kick people out. And the way we look at it is we want consistent returns. We want the prospect, even for our lower incentive fee fund, to have a losing quarter to be, a losing quarter should be very unusual. For our main fund, a losing month should happen once or twice a year. And you can kind of figure out about what that target is. We think that's reasonable. It's an interesting trade-off because things change. You want to make sure the models you're trading are still effective, right? So when you go through a drawdown period, you always ask the question, wait a second, did something change? Is it not working? And there's a lot of rigorous ways to figure that out. But if you have a low Sharpe ratio strategy that has losing years occasionally, and it gets a little harder. If you have losing 3 years in a row, it gets very hard. You start doubting it. So that's how you decide how big you can get. And the bigger you get, the more costs you pay to trade in the market, and the lower you realized alpha is. So there's a formula that trades it off. We could certainly, with our reputation, raise, I don't know, 20, 30, 40, $50 billion more in low Sharpe strategies. We're not doing that. First of all, we'd have to add a lot, we'd have to expand our marketing department from one person, basically. And also then you have to, have a lot of client meetings and conversations about what's going on that's not actually helping you do things. And would it add some revenue diversification to the firm? Potentially, but it would also distract us from our main research mission. So that's the reason we've picked that. We have some competitors that have taken that path, and we have some competitors that have continued to get bigger and bigger. And you also, we do have close to 300 people now. You keeping a culture and keeping it intact when a firm is getting bigger is much harder. And I just can't imagine what it would be like running 1,000 or 2,000 or 3,000 person firm. You don't know everybody, and that's okay. I don't know everybody now, but I know enough people that know people. Like so, there's 1 degree of separation between me and anything else. And if we're 1,200 people, that wouldn't be the case. So it seems to work. We think about maximizing dollar profit per employee.
And I want to take a step back for a second. I think this is a very kind of interesting time in your firm's evolution of after you came back a few years later was '07 and '08. And if I'm correct, if you didn't cut your positions, it would have been one of your best years ever. Tell me a bit about that period. I'm just super fascinated in what it was like for you guys.
There was a quant crisis. It was 2007 in August, near the end of August. Um, and quant, there's low sharp quant and high sharp quant, and the low sharp quant had been doing really well, and people just got bigger and bigger and bigger than they thought. And when I mentioned before that I made a decision that almost took down the firm, I thought we could make our low sharp books much, much bigger. And I went to Morgan Stanley internally, and this is after a period where there was no such thing as risk in the marketplace. And so you have leaders whose risk aversion is far lower. That's very natural. And I said, you know what, we've got all these strategies. We can take lots of outside capital, and we should, because this isn't something we should do internally. And the message I got back was, no, 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 you don't understand. We're really big. We can handle massive drawdowns. And I said, no, you don't understand. But I lost that battle. But I said, okay, fine. And so we took the lower Sharpe ratio stuff, made it much bigger. And as a result, when we went into that crazy week, and what had happened was people started delivering those books and stuff started going down. And then people that were taking too much leverage, the weak hands, needed to start puking, and there just wasn't enough liquidity. So you had even though the market was flat that week, it was crazy. And we had to make some decisions. We actually ended up cutting 2/3 of our book,
Wow.
which was extreme, and we almost went down to zero. But we made back the year on the 1/3 of our book that we kept.
Wow.
We were ready to unload it that Friday, but it finally, it was my poker sense I felt like that it was over, and fortunately I was right. So we held off for a little bit, but it was a scary time. I guess that was 2007, and that was I still remember it. There's not a lot of sleep, because it was a contagion. It went all around, and it was just a reminder. Plus, we just never thought we would have to emergency liquidate, so we didn't know how to do it. We were trading sloppily. I'm sure we weren't the only ones, and so all of a sudden, people are like, "Wait a second, everybody's trying to get out of the way," and so we went out of the way, but it worked out okay. But that was the hardest thing. That was the parallel decision to opening it up and hiring lots of people. The great thing that happened during that week was you kind of saw how dedicated and devoted people were, how much people loved the firm, wanted to stay and do things, right? And then when 2008 happened, when Morgan Stanley almost went bust.
Oh yeah.
I mean, the weekend that Morgan Stanley almost went bust, when Mac was in Tokyo begging Mitsubishi for the bailout, that's the weekend my son was born. I
Oh
was in
wow.
Santa Barbara because I had moved to California, where I live now, and I was there, and I was ready to fly back, right away, because it was absolutely nuts. And fortunately, that didn't happen. But we were fine. We were making tons of money. We
Incredible.
learned so much from that liquidation that when crazy events happen in the marketplace now, we're much better prepared. And
Seems
I
like
was back.
seems like a useful learning experience, although a painful
Indeed,
one.
indeed. When I read that book one day, that week, the Wall Street Journal had I made the front page of the Wall Street Journal, which nobody knew we existed, but because it was the end of August and Morgan reported the quarterly earnings right at the end of August, they had to talk about us and do it. And so the Wall Street Journal published a story that said "Quant Star battered. No time for music now."
Wow.
It's
Um,
funny. Yeah. Anyway.
yeah. And if I'm correct at the firm, you organize researchers into teams by asset class and time horizon. Some work on problems for very short amounts of time, like a couple weeks. Some work on for years at a time. How do you decide what's worth years versus weeks and what gets killed quickly?
So we don't actually organize them that way.
Okay.
We've changed how we approach it, and there's just a lot of judgment that goes into it.
Yeah.
I won't go into details in terms of how we think about things, but I don't. I think if somebody came in and saw it, they would feel like it was common sense. You know, it's what's your level of conviction on something, and what's your credibility? How good have you been at figuring things out in the past? But typically, if somebody is smart and we trust them, and they say, I want to figure this out. I'm not going to stop till I do. We're going to let them do it. There's no, the downside is limited. So that's how we play.
And I want to touch on a couple of questions about you, because you have a very unique background in the sense of you spend two-thirds of your time, if I'm correct, up there in California. Most of it surfing. You perform music. You create New York Times crossword puzzles. And I think you made it to the final table of a World Series of Poker or event. You've created 7 albums as well. Most successful investors that I've interviewed are like completely consumed by markets. Do you think not being consumed by markets is a competitive advantage?
I think it makes my life much more fun and much more interesting. And I think the thing is, I'm pretty good at what I do. I'm pretty smart, and when I obsess over something, I get really good at it. But what I love being able to have people learn what I do and then do it better, right? So I have a bunch of crosswords that are in the Washington Post, but I've mentored some people that create them. And I can't do that with music. I gotta create the music and do it myself. But in PDT, there are quite a number of people who are I would argue smarter and better than I am in terms of building models and making this work. Maybe I have a little more eminence degrees and a little more wisdom, but my ego is not attached to being the guy who could figure it all out. And I think that makes for a more interesting life. Um, I love to I love to learn, I love to be challenged, and I love to watch other people learn as well. That's what turns me on.
And at this point in your career, you could retire tomorrow and just make music. What keeps you going?
Oh, that's been true for forever. But the same reason, well, all those things. But part of it is, when I play music, and I do travel around the country, and we do get shout outs. This last record, the seventh record, we got a NPR gave us one of the top 10 Americana albums to come out for the week, which was really cool, unexpected. And if I can go around and play for 90 people in a pin drop quiet room, either solo or with my band, that's a real turn on for me. It's energizing and it's great, but I'm a nobody in the music field, right? And I'm struggling, and a lot of times I'm the opening act. I'm not even changing in the green room. I'm changing in the bathroom. It's cool, and I'm devoted to it, and I've got to pay my dues, and that's cool. And it's not like when I travel to the gigs, it's uncomfortable. It's fine. But when I'm playing, I'm playing. When I walk into the hedge fund world, people know what I did, know what I'm capable of. I feel like, it's a nice boost. I'm like, oh, good. I can be really excellent at what I devote myself to, and so I can use that energy and help myself grow in the other area, which is music. So the combination actually works great for me.
Incredible. And I have one final question. I asked every single one of my guests at the end of every episode. I'm 16 right now. If you were to give one piece of advice to a 16-year-old today, and it can be life advice, it can be career advice. Jeff Yass gave me romantic advice. What would it be?
I want to know what Jeff Yass told you.
Jeff said that ask your friends what they think of a woman before marrying her. Because
Oh,
they're much more rational about it than you are, and they know you better than you know yourself in those kind of moments.
that is great advice. The first thing I'm going to tell you is, um, holy shit, you're 16. I mean, I knew that going into this, but you're incredibly impressive for 16. You're well spoken. You're thoughtful. Um, you're way ahead of the game, which is fantastic. And you clearly have a great, bright future ahead of you. The piece of advice that I would give, and I'll give my kids this, is there is a sure signal that you get when you are operating in the world that you're doing what you're supposed to be doing, and that is the energy. And it's follow the energy. If you're doing something and it makes you feel alive, do it more. If you're doing something and you feel dead, or you feel like, oh, okay, I should do this, you don't have to do it, right? You can make your own rules, but if you pay attention to energy, people will be drawn to you, and you'll be able to figure out whatever you need to figure out. It takes a while sometimes. You have to stick with it. But if it's energizing, it's not hard, right? There's all sorts of other things about being disciplined and, setting things, but following the energy is the one thing that I would say.
Extremely sound advice. Well, thanks for coming on. It's been a pleasure. Thanks for taking the time.
Totally, totally my pleasure too. And the one thing I'll tell you is if people are listening to your podcast and going, wait, he plays music? That's interesting. How can I check it out? If they go to Pete Muller, PeteMuller.com, they can find me there on Instagram, Pete Muller Music, Spotify, Pandora, everywhere. You just look up Pete Muller.
I'll add it
And
to my playlist.
awesome.
All right.
Cool.
Well, great doing this, Pete. Really appreciate it.